Okay, well, good afternoon. Welcome back to our three-day conference, day 2 of our three-day conference on digital finance and sustainability. My name is Prof. Dave Fernandez. I'm a professor at Singapore Management University, where I direct the Sim Kee Boon Institute for Financial Economics. And we are co-hosting this event with our partners from the Asian Development Bank Institute. The purpose, again, broad picture for the conference is to feature new research on digital finance and its implications for sustainable and inclusive economic growth. Day 2, session 2 of the conference will be commenced now. I will chair this session, and the session focuses on financial inclusion and digital payments systems. So we will have several papers in order, counting from yesterday's session. These will be papers 5, 6, 7, and 8 for this session, where we will have for the first 3 presenters and then discussants for those papers. So without further ado, I'm going to kick this session off and invite our first paper presenter, Mansoor Hossain, who is the research director at Bangladesh Institute for Development Studies. And Mansoor Hossain will be presenting on a paper titled Sustainable Financing Strategies for the SMEs, 2 Alternative Models. So I'll turn the stage over to Mansoor Hossain. You'll have 20 minutes, please, to present.
Okay, thank you, Dev. I'm now sharing my slides first. Okay. Can you please see the slides? Okay. Okay, this, as you heard from Dev, our title of the paper is Sustainable Financing Strategies for the SMEs, 2 Alternative Models. The paper is jointly written with Naoki Yoshino, who is the Professor Emeritus, Keio University, and Kanmei Subota. He is also Professor, Faculty of Global and Regional Studies, Toyo University, Tokyo. The outline of my presentation is, first is the motivation from where we started the paper, and then context and objectives. Then we have outlined simple theoretical model framework so that it can be understood clearly what we are trying to highlight in this paper. The theoretical model framework, and it is followed by some empirical estimations based on some SME survey results, and then we come up some conclusions. Okay. The motivation is first comes from the access to finance issues of the SMEs. As you know that SMEs main bottlenecks in all over the world, particularly in developing world, is there are barriers to access to finance. And to solve these barriers, many countries, many governments are trying many types of models so that they can get credit with lower interest and without collateral. So these are 2 big issues for SMEs not to get the adequate financing for their development and growth. Some of the models, widely accepted models, are like credit guarantee schemes, business angels, factoring methods, etc. But all have their own limitations. And we are proposing here a new one. Particularly, we take the motivation from a credit program. This is known as wholesale credit program, which is implemented by a government agency in Bangladesh. So in Bangladesh, SMEs is a very predominant in its industrial structure. 95% are SMEs in the industrial structure. So it's a very important, they have a very important role in economic development. And also their financing is an important aspect for the country so that they can get the due finances so that they can continue their business and activities. This is the credit wholesale program mainly comes from, in a sense that when the credit interest rate was above 15% or 12% in the market rate, then the government agency, SME Foundation, which provides funds to the banks at a subsidized rate, interest rate, and they ask banks to provide SMEs at a interest rate 9%, so single-digit interest rate. And then also they ask them not to take any collateral. This issues or this problem is minimized because the program is run in a selected areas, clusters, and the cluster members, particularly SMEs, are the beneficiaries of SME Foundation. Beneficiaries mean they got training, they have the database, SME Foundation database of these farms in different clusters. So they ask bank that these farms can afford this credit without collateral and you will get back. And over time, we see that the repayment rate is very high, 195%. The problem is that SME Foundation has funding limitations, though it is a government agency, so its coverage is also small. Though the program is very well managed and successful, but the problem is that scalability is a problem of this program. So let us test whether this program is theoretically consistent and internally consistent. So we consider three sectors. One is the government sector, because government has policy objectives to provide adequate fund to the SMEs. So bank is also involved in SME sector. So three sectors are involved in this process. While the public sector has an objective of increasing the supply of loans to SMEs with low interest rate, however, they should have some instruments in place so that banks can increase their profitability, because it's also banks' problem that whether they can get the profit with lower interest rate, and so credit flow into the good SME borrowers. So their default risks must be lower. So this gives us our main theoretical frameworks, main concerns. Second, we see that since this is the government fund flowing to the banks, and there should have some problem of adverse selection, and also that could, if the coverage increases, fund is increases, there should have some political considerations in the selection process, and it might create some moral hazard. So we see that in the long run, this credit wholesale program might not be very sustainable. In the short run to medium run, if its scale is smaller, it is possible with a high successful repayment rate. But in the long run, with the higher coverage, it may not be sustainable. Therefore, we come up with some solutions. That is, we call it a blended framework of digital finance with agency-based approach. The agency will provide some information about the borrowers. They will provide training, and they will improve their human capacity and other capacity of the SMEs. At the same time, an agency of the government will provide some credit risk database. Credit scoring will be done, and so that they can get some microfinance for digital microfinance, and it will reduce the transaction cost of the banks also. So without giving fund, then we are proposing that an agency will provide some information about the credit risk and credit worthiness of the borrowers. And at the same time, another agency, maybe government agency like SME Foundation, could provide some training and capacity building support to the SMEs. That will reduce the asymmetry of information. At the same time, it will increase the capability of the firms to repay their loans. So this is the main argument and motivation of the study. So here you see that the government first policy objective function, which depends on the loan, credit loan of to the sector. Here's L star is the desired loan, L is the current amount of loan, and then rho is the credit default risk. So our standard or this optimum level of credit default risk is rho star. So after skipping some steps, the final loan demand function for equation 1 stands at this one, last one, where it depends on the interest rate as well as the output of the SME sector. And SME sectors, we assume that a Cobb-Douglas production function, and it depends on these human labor forces and And also capital is a loan, which is dependent on the row. Row means a default risk. So therefore, the log linear form of the loan demand is the finally stands out like this, the third one, last one. Then we say that with interventions like the credit wholesale program, if government provides some subsidized fund with a lower interest rate, then it will also reduce the loan default risk, that is row star and R star. So that could be the last one. So here you see that two types of loan demand function exist with this program. One is the LD, another LD star. So two types of borrowers are handling by the banks. So one set of borrowers are getting interest rate at R, which is higher than, which is a market rate, which is higher than R star, and because the borrower's information is not in hand of the banks, but in the second one, banks have the information as well as banks get some subsidized fund, that is the deposit of the banks in one sense. So banking sector's profitability function is here as we defined. First of the is interest rate. Row is a function of G. We call it a kind of information because information is important for the banks to get the default risk lower. Then deposit rate and cost of the function banks, which it depends on the loan and deposits. So finally, loan supply function is you see that LS equals to 1/2 C1. That is the cost of banks lending loan supply, which is also dependent on real interest rate. And we again redefine rho as a function of G. G means some information of the borrowers, and MC is the marginal cost of lending. RD, deposit interest rate, and C1 LS, loan supply, and C3D is the cost of deposits. Finally, after intervention, we just rewrite the equation 13 like this with a new loan star, and then all are as I mentioned before. And finally, we get the L star is like this. So here again we say that this L star and LS, two types of loan demand, loan supply is existing in the banking sector at this moment. One part is based on subsidized fund, with which is very successful in terms of lower interest rate and lower default risk. Another one is bank's usual lending process, which depends on the interest rate, which is higher than the subsidized one, as well as the loan supply is definitely limited, but must be higher than the equation 14. How it could be improved? So as I mentioned earlier, that if this is at this moment is better, but it may not continue sustainable in the long run because of moral hazard and adverse selection issues. So we are coming out of this providing fund from the banking government side. If government does not provide fund, then government does not have to say about their selection of the borrowers. Therefore, instead, government can provide the credit scoring analysis, credit risk analysis of the SMEs. For this, they should have a big database, as in Japan, and this information can be shared with the banks and also SMEs and agencies, so that it can be available to anyone as and when required. So this is one part of the support that government can provide by an independent agency. And another support which is still continuing, like SME Foundation is providing some training and others, so their capacity building continues, as well as they can improve their human capital so that they can improve their business promotion and other things. So we are proposing that now with this credit information, banks will apply some digital platform to disburse loans and also to collect loans. That is digital microfinance. Because microfinance, I am saying that because SMEs financing is also smaller. So it is possible to transfer through the some mobile financial services or others, so that it can reduce the marginal cost of lending or borrowing from the banks, borrowing from the user's perspective. The reason is that it involves some cash out, cash in fees and other things. So it may not involve the personal transaction cost. Definitely would be lower because of it does not need banks to send these officials to borrowers and to monitor it. It reduces definitely monitoring cost of the banks. So therefore, we define the role default risk as a function of ICT. That is also information comes from CRD, credit risk department or database. And MC marginal cost is based on ICT, that means digital platform, so that it will reduce to some extent. Then we define the last equation in this way. This is just a simple form of the equation 14. So our now the question is whether current one, second one, this one, ICT-based digital financing one is better than previous one. One problem it can solve is the introduction of the CRD, credit risk database, and another innovation is here that bank will now transfer money based on CRD through some ICT-based digital financing process. So if digital finance approaches are maintained properly, successfully, it is possible that this model could be better than the previous existing one. Okay, now since this second, the main argument proposed model is not possible to test empirically because it is not in place still. We have shown that how the current existing program are empirically tested, in fact, analyzed in this paper, so that it can give us some idea that the current program is good in a sense. So at survey data of 526 SMEs are considered here. The survey was done in 2018. Out of this 526, 104 firms, in fact, were the CW, I mean Credit Wholesale Program beneficiary. And these beneficiaries are not the beneficiary of at a time. So we see that from 2013 to 2017, they got the treatment. Treatment means they enter into the programs in different years. So 8 firms received in 2013, 11, 2014, and 37, so on. So our empirical strategy involves that different firms receive treatment in different time points. So it allows us to use the differences in difference approaches. So we first run the following difference in differences regression. Here is a time dummy. If a farm, SME farm, receives treatment in a particular year, so it gets one, dummy variable in the subsequent years, and treatment is when it gets treatment, because for each year a certain farms are treatment and the others are control and non-treated, and for the second year, so another group of farms got treatment, CW beneficiaries and others. So it is possible in this framework to see the treatment heterogeneity within the farms, as well as the comparing the control groups.
Answer, just if you can get to the result, we have just a couple of minutes, please.
Okay, thank you so much.
Thank you.
So in our empirical analysis, I think we get some good results. It shows that this program is very successful in terms of, you see that last row. So this is very successful in terms of increasing sales revenue, profit, and other things. So as we mentioned, and also we also check whether this gives farms to get some spillover benefits, because already they got some reputation by involving in the CW program. So they get some loans from other sources, because this is not enough for their financing. So that also shows some important findings, that these farms got some better access to loans from other sources too, not only banks, from other sources too. So this is the main argument of the paper. We find that CW program is very successful in terms of increasing sales revenue and others. At the same time, repayment rate already side. But based on the future sustainability, we think that this program may not be sustainable if its coverage increases, the scale increases. So we propose a different method, alternative method that involves digital financing as well as government agencies, some sort of intervention in terms of training and others. That's all from my side. Thank you so much for your patient hearing.
Thank you. Thank you very much for that presentation. I'm going to turn over to our discussant for this paper, Professor Shinichi Fukuda from the Graduate School of Economics, University of Tokyo. Professor Fukuda, please.
Okay, thank you very much. Thank you for inviting me to discuss a wonderful paper. And paper is very, very interesting. And the motivation of this paper is to find a good mechanism to overcome the problems of financing problems of SMEs. And as also already discussed, SME have a serious problem to access the formal finance. They usually face a serious borrowing constraint, and even when they can borrow, they need to pay a high interest rate with the stringent collateral requirement. Furthermore, most SME need to depend on informal sources for which the costs are very high. So the SME cannot meet their finance needs in most emerging developing countries. So that we need to explore financing mechanism overcome the problems. And this is the motivation paper. And this paper is a very, very interesting attempt to solve this problem. And this study suggests two alternative financing mechanisms. One is the government subsidized loan fund. And they shows its importance both theoretically and empirically. And also the paper suggests that the credit database and digital finance mechanism would be a good alternative only by theory. And I think the empirical analysis was very interesting, and that uses a survey of SME in Bangladesh, and it shows the government subsidized loan fund mitigated the borrowing constraint and improved the performance of SMEs in Bangladesh. And the results are very, very interesting and worthwhile to be noted. And also that it has a lot of policy implication. I have basically three comments. One natural question is why the government subsidized loan was so useful, so successful in Bangladesh. And of course, there was some, in theory, there was the model is sort of a reduced form. So it was, story was in the black box, but we need to discuss more extensively why the government subsidized loan was so successful in Bangladesh. And if the government has a better information of the borrower, it could reduce the default risk and increase the amount of lending. And that is true. However, we need to see why the government has a better information than the private financial institution. And it was not necessarily clear in the current version. And I think there are two types of information. One is the hard information, such as the accounting information, sales, profit, and so on. But they are the public information, which is probably available for both government and private institutions. But at the same time, there are some soft information that might be available only for the government. For example, government knows its own micro and macro policy better, so it can see which SME can grow under the policies. Also, the government subsidy loans are usually accompanied by the other government programs, so the government may find a good borrowers through the programs. And I think the Bangladesh program is a very interesting, and it's a very noteworthy case study on the subsidized credit program. And SMEF, that's the foundation which initiated the program, provides various trainings, consultancy support on business process, management information systems, accounting procedures to the beneficiary firms. And I think through these trainings, the government might be able to have better information of borrowers. And empirical results show the program improved the sales, revenue, profit, and productivity in Bangladesh. And interestingly, that they are consistent with the theory. But I'd like to also see that it was reliable to test whether the program reduced the default risk, because the model, the default risk is a key assumption. Reducing the default risk is key assumption. But empirical analysis didn't directly test how the default risk was declined. Probably that default rate was quite low under the program, so that you may confirm that point too. But it should have been more interesting to see how the default risk was reduced under this program. That was my first comment. My second comment is on the limitation of government subsidized loans. And as we already discussed, that Bangladesh, it was a successful program, but they may also have some limitation. And one limitation is the loan amount and number of beneficiaries would be limited due to the government budget constraint. That part was discussed in the paper. But in addition, there are another problem that was the possible moral hazard, rent seeking, and political interference that may arise for the government subsidized loans. In most countries, that happens. But I'd like to see why that type of program didn't arise so seriously in Bangladesh, and that was very important to be discussed. In the current version, I couldn't see well about this type of discussion, so that it is desirable to have discussion on this. And in the credit database in Bangladesh, in case of in the paper alternatives are suggested. That was the credit database and digital financing mechanism, only by theory. But I'm wondering whether this type of mechanism is substitutable for the government programs. I think it's complementary. This is because the information they can utilize might be different. I think both might utilize not only the better hard information, but also soft information, which is not publicly available. But it is likely that information the credit database can utilize is very different from the information that government can utilize. So my impression is that it would not substitute for the government subsidized loans. Instead, it might complement the government subsidized loans. So it was desirable to have discussion on this type of discussion in the paper. My third comment is more technical difference in difference regression. That was very interesting. I think most interesting result in the paper. And that the analysis was carefully done, and treatment group was beneficial firm that had received the credit, and the control group is non-beneficiary firms that did not receive the credit but are potentially eligible for credit. And as many DID analysis shows, that beta 3 is a key coefficient, and that captures the impact of the government subsidized loan on the outcome variables. But in case of DID analysis, it is implicitly very important to firms in treated groups are similar to those in control groups before receiving credit. But I'm wondering the assumption might be consistent with the theoretical model. And empirical analysis has been carefully done, actually. And I think that was very good. And both beneficiary and non-beneficiary have received the training and consultancy support, and also probability proportional to size method has been applied, and also various control variables included in the evaluation. And also it shows that previous year's performance of a firm was not significant for receiving loans for the CW program. So that they show that the analysis was relevant, but still I'm wondering whether the CW program has selected specific firms by using some software information which is not controlled well in the program. And actually, theoretical model suggested that this possibility. So that implicit assumption in the empirical analysis and theoretical suggestion is not necessarily consistent. But anyway, it was very interesting analysis. And my final comment is just a clarifying question. I couldn't see well about the definition of time, and I first thought that time is just a time trend, but in the paper it shows that it's a dummy variable that takes value 1 if the year corresponds to the year after the intervention. So I thought that the time split, a subscript of time is not the T, but TI, but I'm wondering that understanding is true or not. That's just a clarifying question. Okay, thank you very much.
Thank you so much, Professor Fukuda. I mean, so actually there is one question that's posted by John. Maybe I can ask you, John, if you could open your microphone and camera if possible, and just ask the question first to Mansoor, and then we'll give the author a chance to respond to the discussant's comments as well as your question.
Okay, thanks, Dave. Thanks very much, Mansoor, for excellent presentation. So my question, you can basically read it in the chat. So I think that it's not very clear in the empirical part if the analysis is about financing in general or some digital finance component, and also so there need to be clarity on that. And the second point is about linking the theory to the empirical part. So I think you developed the digital finance mechanism in the theoretical model very nicely, but then the empirical part seems to be like almost a separate section altogether. So it would be useful if a better connection could be made between the empirical and the theoretical part. So
excellent, thank you, John. So unfortunately, you have 4 minutes to respond to the very rich set of discussion points raised by Professor Fukuda as well as John's question. So back to you.
Okay, thank you so much, Professor Fukuda. It's very nice to see you and get all these comments, very important comments. I think what I have said and what you have said, we do not have very much disagreement in most of the cases. The reason is that digital finance part, even John can get the response from here, because digital finance aspect has not been initiated in Bangladesh yet. We do not have any credit risk database department or this kind of thing. Recently, this is coming up for the NGOs, for microfinance institutions. It is still in the experimental state. So it is very difficult to empirically test this part. I think you can think of it, this is a part of theoretical contribution, and maybe then in the future it might happen and one can test digital part with the CW program. But our main at this moment, we are not saying that first one is very bad and second one is very good, but we are saying that first part, CW program, government subsidized program based intervention is might have some sort of problems, which is not yet what Professor Fukuda asked, why it is not involving moral hazard and other problem at this moment. My argument is that it is still the size of the loan, amount of the subsidies is very low, small in size and small in amount, and it is a limited scale piloting type program at this moment. That's why it is not taking up this kind of problems at this moment. If government take it as a policy program and start implementing the whole country, then we think that this kind of problem will arise. So digital financing platform in Bangladesh started even in the mid of 2010s. So it is still in the premature situation. So we do not have that kind of data to test. But we thought that based on Japan's experience and others countries' experience, that could solve many of the problems of the current CW program. So both programs are equally important. One is trying to solve others' problems. That is what we tried to mention here. And time variable, I think it's a kind of the 4 years panel data. So 2013 to 2017. So this time captures the intervention years, as you already mentioned, and that is what we have done in the empirical part, so that it can capture intervention and time dimension at the same time. Whether a firm has a longer term experience of intervention or not. That is also important in analyzing their impact. Because if a farm gets the loan this year, this may not be reflected in next year's improvement of its performances. So we saw that whether if a farm gets intervention for a longer term, they might have some improvement in its performance, human capital development, productivity enhancement, like this. That is what we have considered time variable in this way. So still, it is true that digital finance part is disconnected because as we do not have data, and this is not implemented in Bangladesh. But we hope that this could, if the government or if the other agencies could adopt this kind of program, it will be helpful based on the best practices in other developed countries. That's what I can say at this moment. Thank you so much.
Thank you, and obviously a very interesting paper with some super interesting comments and discussion. And so thank you for that presentation, for the discussion.
If I get comments, Professor Fukuda, if you could share with us later. Okay.
Absolutely, and I think we'll certainly be facilitating the sharing of that feedback after the conference wraps up. Thank you. Excellent. So we're going to move on to the sixth paper in our conference, second one for today. So I want to give the stage to Prof. Kiki, who's a lecturer at Mae Fah Luang University in Thailand. The paper being presented is entitled Imagining an Inclusive Economy, the Role of Digital Payment in Elevating SMEs' Contribution to Economic Equality. So over to you, Kiki.
All right, thank you so much, moderator, for introductions. So I'm Kiki Koivin and my colleague Zaki Hadian Ahyar from Mae Fah Luang University, Thailand. But first of all, we would like to thank especially to Asian Development Bank Institute and also Singapore Management University for organizing this great conference on digital finance and sustainability. So we would like to present our paper entitled Imagining an Inclusive Economy, the Role of Digital Payment in Elevating SMEs' Contributions to Economic Equality. But first of all, let me start with the introductions. So talking about financial inclusions, because we can see there are many academic conferences and they have the themes about financial inclusions and sustainability. Financial inclusion means that individuals and businesses have access to useful and affordable financial products and services that meet their needs, including transactions, payments, savings, credit, and insurance. So being able to have access to a transactions account, for example, it is first step toward broader financial inclusions, since a transactions account allows people to store money and then save and also receive payments. So a transactions account serves as a gateway to other financial services, which is why ensuring that people worldwide can have access to a transactions account continues to be an area of focus of many development institutions. So therefore, we can see a couple of economic benefits in terms of financial inclusions. For example, here, helping low-income people in managing risk, absorbing financial crisis, and also establishing a strong foundations for an inclusive economy by increasing job creations and investment. But anyway, there is still a long-standing conundrum, especially those excluded people are still left behind in the development of financial inclusions, especially low-income class remains underserved in that they assume that they have no money and don't obtain potential advantages from financial services. But we are still optimistic because in the long run, economic growth will touch all segments of society toward the well-being of all, including the poor and vulnerable. So the center of this research study actually small medium enterprises, and we know that SMEs represent the first step in the career and world of entrepreneurs, and this is an essential attribute of small medium enterprises. So as proved by like the third 2/3 of the newly created jobs are out to the small and medium sectors. So small and medium enterprises are drivers of new ideas and assemble of new process, accelerating the increased rely on more effective use of resources. So in today's advanced technology, we see like growing sophisticated technology, and it can create advanced technology system that can enable people to connect and then interact globally on real-time basis, including in financial sector. So our sample actually 3 Asian countries, including Indonesia, Thailand, and Singapore. So this is a glimpse of digital society in these 3 countries. The data from World Bank in 2021, populations who has access to the internet age above 15 in 2021. In Indonesia is around 51%, and in Singapore is around 94%, is very high, and for the Thailand it is around 80%. And I would like to move to the data about the populations who use a mobile phone or the internet to buy something online, again above 15 years old. So the data shows in 2017 and 2021. In Indonesia, it represents around like 10% of the populations who use a mobile phone or the internet to buy something online, and a slightly increase in 2021, around 80%, 18%. And in Thailand, for example, here, in 2017, 70% of populations use a mobile phone and the internet to buy something online, and in 2021 is around 51%. And in Singapore, 2017, 48% the populations, and jumped to 58% in 2021. So this is the data about the populations who use the mobile phone or the internet to buy something online. So this one, in terms of made a digital payment, the data from 2014, 2017, and 2021. So in Indonesia, 2014 has 16% of populations digital payment, and moved to 27% in 2017. In 2021, it's around 29%. And in Thailand, it's not really different, but in 2021, it's dramatically increased, and it's from 84% of the population paying digital payments. And interestingly, in Singapore, of course, the better digital payments has a bigger number among 3 Asian countries here. Like in 2021, it shows like 91%. All right, so I would like to move to previous studies. So we tried to review some literatures related to our topic. So first here from Adam et al. 2015. So they found like a significant relationship between small medium enterprises financing and poverty reduction. And Cow et al. 2019. So they found like the role of small medium enterprises on poverty reductions in Nigeria reinforced the fact that small medium enterprises development can alleviate the poverty. Because we try to incorporate a digital platform as well here. So we try to find literature related to digital payment. And from Hindato et al. 2021, so they found like when community utilizes innovations in information technology, they can seize opportunities, particularly for small and enterprises entrepreneurs in carrying out financial activities anywhere with ease, safety, and control. So this is the empirical model in our study. So we have 3 variables: small and medium enterprises, and then economic inequality. And for the moderating variable, we incorporate digital payment. So how can we measure the variable in our study? For the small medium enterprises, proxied by percentage of small medium enterprises contributions to GDP. And for the economic inequality, we use Gini coefficients. And for the digital payment transaction value within country. So sample again, Indonesia, Thailand, and Singapore, and data are from 2010 and 2021. And we analyze data using panel data models. So before we test fixed effect model in panel data. Actually, we test many tests, for example, like show and then Hausman test. And when it comes to Lagrange multiplier results, the result is appropriate for fixed effect. So this is our result using fixed effect model. So if you see the probability, especially for digital payment as the moderate, the variable, moderating variable. So it shows like digital payment strengthens the small and medium enterprises' effort to reduce inequality. So based on the result, undoubtedly that small medium enterprises have brought a critical role in sustaining the viable economy of the country. As small medium enterprises as well serve the primary innovative catalyst for the whole economy. And based on our finding as well, the digital families can strengthen the small medium enterprises' effort to reduce economic inequality. Because we incorporate digital payments variable as well. So cashless system makes the financial transaction more transparent, scalable, and accountable. And the increase in people's participations in economic activities incorporated by transformative digital payment will lead to poverty reductions where equitable economic growth is more feasible. So more employment generations, poverty alleviations, and economic growth can be found within digital payment adapting countries, especially in our sample like Indonesia, Thailand, and Singapore. So this is some recommendations to specific countries. For Indonesia, digital finance is the key to recovering and transforming the economy. So severe inflations and economic contractions have devastated the economy, which require a breakthrough to approach the problem. So digital finance service that expands people access to finance and elevate the cost of digital transactions are the most applicable policy to implement to overcome the economic turmoil, especially for Indonesia. We know like there are many remote areas, and for the bank actually it's quite difficult and hard to open a branch in remote areas. So incorporating or implementing digital payment in kind of rural areas is very relevant. And for Thailand, convenience, user-friendly, and reliability are vital features for developing electronic payment in Thailand to attract more users. The e-payment system should be able to accommodate the different needs of the different market segments, especially, for example, farmers may need more access to online loans for working capital, while corporate men may need more access to vehicle installment and insurance and so on and so forth. So improving digital financial literacy. So this is quite vital for Thailand actually, how the governments of Thailand can encourage many people and to give knowledge about the financial literacy and to raise awareness in using digital people for potential users. For Singapore, more collaborations between public and private funding can achieve a more sizable impact on sustainable digital inclusion. And the social entrepreneurial system can be the best winning solutions for telecommunication companies, and the people where companies with bigger market share are supposed to provide financial assistance for digitalization initiatives nationwide. So I think it will be more like pragmatic, okay, for especially digital finance in these three Asian countries. So because in Indonesia just finished G20 summit, and there is related like agenda in terms of digital transformation. So G20 declarations acknowledge young people to develop digital transformations, and more importantly, they encourage international collaborations to further develop digital skills, and specifically in terms of digital literacy. And this is very important as well to enhance cross-border payments, especially like Indonesia, Singapore, and Thailand. Thank you very much for listening.
Okay, very good. Thank you for that concise presentation of your paper. We're actually a little bit ahead of schedule, which is great. And leave more time for the discussion and questions and answers. So why don't we go straight away to our discussant for this paper. Sarat Dal is our discussant. Sarat is Director of the Payments Systems Division, Department of Economic and Policy Research at the Reserve Bank of India. So Sarat, the floor is yours. Thank you.
Something is happening. I don't know. Anyway, I would say I'll read out my comments. So I've given my technical comments. The first thing, they should have a baseline model where they should have this called first, imagine a situation that you don't have a digitalization. The second situation, you have a digitalization with SMEs. The baseline will be only SMEs contribution to the inequality. Then analyze what these two models parameter estimation suggest. So whether the impact of SMEs model, coefficients of the SMEs in the basic equation, baseline model improves or say when you include a digitalization indicator. This is the first thing. It was my suggestions, and there will be a whole lot of scenarios because your parameters of interest, whether that can digitalization can have a level shift impact on inequality, or I've shown you 4 sorts of scenarios, and also there are other couple of scenarios also I've indicated that the author can look at. And a third alternative strategy is, if you are what your title of the paper suggests, that digitalization induces or say elevates SME's contribution, then that's one way what I suggested. Another way is to include like the previous presenter, a cross term model, like SME into digitalization indicator as an regression, and see what the parametric changes happen without digitalization model like baseline model. My other comments are scaling of variables, time fixed effects, limited sample size. This is one of the most worried part of this paper. 3 countries, 11 years, 33 observations in total. So it barely satisfies law of large numbers, that's 30. But then this is a special case of panel data, mostly called n less than t. It's called large panel. Usually most studies focus on short panel, where n should be sufficiently larger than t, and dynamic panel data of RLN and bond, but this cannot be done here. But the problems with this kind of sample or the model n is less than t, the author needs to follow a nice article I have shown, Labra and Torredilla, and other comments, limited sample size. Singapore may be an outlier, as compared to other 2 countries like Indonesia and Thailand. Maybe an appropriate study will be increase the sample size to all ASEAN nations so that you overcome this shortcoming of the empirical models. There are a lot of robustness checks I have highlighted, and motivation paper should be hypothesis based and clear. It cannot be very generic, and the conclusions need to derive from your analytical insights rather than more like generalized kind of thing. And literature, what are the channels through which digitalization of SMEs can alleviate inequality? So like say financial inclusion channel, the reference I have given, removal of credit gaps, that's an ADB study, fantastic study. There are a lot of channels on that, and productive growth and employment channel. So these things should appear in your literature, should be more exciting, and some proofreading required, and which I have indicated in the corrected PDF version of the paper. Thank you very much. Hope I am successful.
Thank you so much. And so Kiki, response for that?
Okay, thank you very much, Sarat, for the comprehensive comment, and I believe that it can improve our paper in the future. And yeah, especially in terms of data collections, actually, we find difficulties, especially from Singapore, because yeah, it's not like available some like a year or something like that. So Thank you so much for the extensive. Okay.
Very good. I apologize. Obviously we had a little bit of a technical issue, but I'm sure between the discussion and the authors, we can have a more extensive, direct interaction. Before I close, though, I did want to ask if there's anyone else who's online who wanted to post any questions for the author. Okay, well, with that, thank you both for the presentation, for the discussion. We're going to take a little bit of a break here and regroup. Hopefully, the technical issues will not be apparent in the second half of the next two papers, and then we will have our keynote, joint keynote presentation following the next two papers. But for now, we're going to take a coffee break. We will adjourn on the hour, so that would be 3 o'clock Singapore time, 4 o'clock Tokyo time. So I'll take a coffee break and be back on the hour. Thank you very much. All right, very good. Welcome back to the second half of day two, and second half in terms of our academic papers. We have two papers in this section. I will turn the stage over now for paper 7 to Professor Ebru Segili from Yasar University in Turkey. She will have 20 minutes blocked out to present her paper, Analysis of Factors Affecting Actual Usage of Online Payments Using Multi-Criteria Decision-Making Approach. That will be followed by a discussion. But first, over to Professor Segili for your presentation. Over to you.
Thank you, Mr. Fernandez. Good afternoon, all the conference participants. Although it's morning here, I'm going to start my presentation. All right, today I'm going to present analysis of factors affecting actual usage of online payments using multi-criteria decision-making approach. And first I'll introduce the authors, and then abstract, introduction, legal framework of payment systems in Turkey, literature review, theoretical background, research methodology, results, and conclusion. Our first author is Melih Coşkun. He is my PhD student. He has been working in a bank since 2007, and currently he's working as a bank branch manager, in one of the biggest banks of Turkey. And this is me. I have also working experience in the banking industry, but I've been working in the university since 2007. And my research areas are financial accounting, fintech, auditing, banking, corporate governance, and corporate reporting. And my colleague, Professor Yücel Öztürkoğlu, our third author, she has put contribution in the methodology part. She's an industrial engineer, and she's also the director of the graduate school at Yasar University. Now I'll continue with the abstract. Research extends the technology acceptance model by examining the impact of relative advantage, personal innovativeness, perceived risk, health, and epidemic on actual usage of online payments. This study explores the adoption of online payments by evaluating crucial factors independently. In order to do that, a literature review is conducted to determine the main factors affecting the actual usage of online payments. The relationship among the factors which impact usage is analyzed with the best-worst method. It is one of the multi-criteria decision-making models used to prioritize the criteria for guiding future implications. And this work aims to contribute to online payment services, the effects of which can be seen in the nation's e-commerce activities. This study provides a holistic framework to guide financial service providers and managers. Sustainable innovation offers advantages like economic issues, social, I'm sorry, there's something wrong here. I'm trying to take this down. Social standing, other rewards and costs associated with selecting the new product. The majority of fintech innovations offer financial advantages to the economy, including reduced payment fees, lower borrowing interest rates, simple access to cash, and better investment returns and rewards. Efficiency, time, and effort savings, such as shorter transaction durations, are further advantages. Furthermore, many people have gained social respect in the millennium by expressing their familiarity with the most recent technology and social media. The rapid growth of social media proves that members of society desire to achieve status by adopting the creative behavior of others. Now, the majority of fintech ecosystem participants in Turkey are involved in payments. Startups are operating in the areas of payment service, prepaid and discount cards, new generation cash register, order screening, in-store payment, mobile POS, money transfer, remittance, bill payment, collection, and crypto payment. And the Turkish card payments market signed pioneering applications in Europe and worldwide. In the 2000s, starting with 2006, Turkey issued Europe's first contactless credit card, followed by in 2007, Turkey became the third country in Europe to complete its transition to cards with chip and PIN. And Turkey's digital wallet, BKM Express, has been launched by 2012. And in 2016, we see Turkey's first payment method launched, which is called Troy. And currently there are 84 million credit cards and 150 million debit cards in circulation. And there are recent regulations related to the payment systems in Turkey. And with these regulations, now Turkey has become PSD2 compliant. By PSD2, we mean the Payment Systems Directive 2 launched in Europe. And now these services will enable data sharing between banks and fintech companies subject to authorization. Now banks will be converted to API banking and boost their initiatives to deliver high value added goods to their consumers due to the APIs that enable these services to be used. And in this article, we refer online payments as internet payment techniques. And when we look at the early theories, we see theory of reasoned action, theory of planned behavior, unified theory of acceptance and use of technology, innovation diffusion theory, where our model is based on technology acceptance model and technology acceptance model extensions. When we look at the recent research based on these early theories, we see that most of the research is based on mobile banking, and also we use these sources as our literature review. We just see that Sven Tao investigated the actual usage of digital payments. And during the COVID-19 epidemic, let me take this pen here. During the COVID-19 epidemic, we have performed a research to evaluate the factors that impact the adoption of online payment systems among the customers of a Turkish bank. And this current study's theoretical foundation is based on the model proposed by our early study. And in the theoretical background, I'll just quickly define the factors. Relative advantage is the individual's perception of online payments as superior to traditional methods of payment. Perceived risk, customers' belief in the unpredictability of online payment. Complexity, it is the extent to which online payment is considered hard to use. perceived integrity. It is the deployment of principles and the concept of honesty in online payments. And perceived integrity, personal innovativeness, the willingness to experiment with new technologies, health and epidemic effects, the changing payment and shopping habits due to the epidemic, perceived usefulness, the extent to which a person uses online payments will be beneficial. And finally, we see the perceived ease of use. It is the degree to which a person believes it will be easy to use online payments. And our main research questions are, the first one is, which factors have the most impact on the actual online payment usage? And the second one is, which factors have the least impact on actual online payment usage? And we use best worst methods. It's one of the recent multi-criteria decision-making methods. And the logic of, unlike other methods, the method focuses on choosing the best and worst among the chosen alternatives. And the basic logic of the method is, first, the most and least desirable alternatives are determined, then pairwise comparisons are conducted between the best and worst and the remaining alternatives. And within the reliability of this approach, the consistency ratio is calculated. And it has 6 steps, which are performed in the following order. So I'm not going to go into detail. I may have time problems. So I continue with the analysis. In the theoretical background, 8 identified factors were selected, and these factors, as I said previously, relative advantage, personal innovativeness, perceived risk, perceived integrity, perceived usefulness, health and epidemic issues, complexity, and perceived ease of use. And the best worth method determines these factors, relative weights and relatives. And to apply this method, e-questionnaires were conducted by the experts. Expert judgments established the choice of the best factor over all others and the preference of all factors over the worst factor. And the responses are then utilized as input for the best worst approach, and the weights are calculated. The survey respondents were picked using a form of judgmental sampling. Thus, experts from the institutions of the Turkish payments ecosystem listed in this table, assisted via email in defining the weights of 8 factors. This study selects the subject matter specialists who can contribute to the research with their expertise while assembling an expert panel. So the specialists have at least 10 years of expertise in the financial industry. And now I'll come to the results. As we see, the most important factor is determined by the experts is perceived usefulness, followed by relative advantage. The third factor is perceived ease of use. The fourth one is perceived risk. And the fifth one is perceived personal innovativeness. The sixth one is complexity. And the seventh one is perceived integrity. And finally, we see health and epidemic effects, and we see the weights of these factors in a graphical presentation. And according to these results, the experts believe that the usefulness and the advantage of the system is more important than the maybe complexity and other issues. And another conclusion is that despite the fact that COVID-19 is a substantial contributor to the growth of online payments, it appears that the effects are currently diminishing, and the primary implication of this study is that policymakers payment institutions should focus on these issues to promote the use of online payment systems. And thank you for listening me. I'm not sure about my time.
You actually have a bit more time if you'd like to use it.
Do
You have
I?
20 minutes in total.
All right. Okay. And
So you have allocated 6 more minutes if you'd like to use them.
oh, okay.
If not, we can go to discussion.
All right, we can go to the discussion. I would like to hear the feedbacks.
Excellent. I think that makes a lot of sense. Thank you, though, for a comprehensive and concise presentation. And we'll move now to the discussion of this paper. The discussant is a project consultant with our partners in Tokyo at the Asian Development Bank Institute. So over to Eric Sugandi.
All right. Thanks very much, Dave. Professor Saigili, very interesting presentation. I like the topic and then the approach that you use, because although you don't explain it in your presentation, it's like you're using linear programming to assign the optimal weight in your model, best worst model. But there are some issues that I would like to ask related to your paper. The first one is the number of experts that you choose is 10 experts. Is it sufficient for your study, or is there any particular reason why do you choose 10? Is it a magic number or something like that, or do you send more? Do you send your questionnaires to more than a potential or candidate respondent, and only 10 replies to your email? So I want to ask about the selection of 10 experts in your study. All right. The second question that I'm going to ask is about the whether the expert really represent the actual users of the online payment. I understand that the expert represent the regulator and the business players in the online payment industry, but there may be some like a gap in terms of perception between those who are in the side of the regulators and business player to those who are on the side of the users or the online payment users. I'm just asking this, maybe in the next study, you can do a survey to the actual online payment user and compare the finding whether there's like a different gap or perception gap between the regulator, the business players, and the actual users. That's the second question. And then the third one is, do you assign different weight for the experts in using their answer to your questionnaire? I understand that on the quantifying the results or the answers from the respondents, you are using weights, but do you assign different weights for the experts itself? I mean, some experts have longer experience than others. Some are regulators or policymakers, while others not. And then even their regulators or policymakers, they have different influence in policymaking. So if you do not assign different weight for each respondent, meaning that you apply the same weight for all respondents, then how do you just justify your judgmental sampling? That's the third question. And then your conclusion says that the COVID-related health and epidemic issue, HA, has the lowest weight and rank among the factors that affect the use of online payment in your model. And then you also mentioned that the pandemic, or in your paper, epidemic, is a substantial contributor to the growth of online payment, although its effect on the use of online payment is diminishing. So my question is, does the outcome of your the outcome of the HE factor from your model challenge the common belief or assumption that COVID-19 pandemic accelerated the use of online payments? Because we see a lot of papers, and articles in the media, in the journals, saying that the COVID or pandemic accelerate or increase the use of online payment or online transaction. But is it really true? I mean, like maybe it's just like a temporary trend. So when the pandemic is over, people will return to their usual habit in using, say, cash in doing transaction rather than using the online payment? That's the fourth question. And then please go to the next slide. All right. These are just the some minor or trivial issues. Better you explain the what is PSD2 before using the term throughout your paper, and then others are trivial. And then what is CI? Maybe you can explain it in your paper. That's all from me. Thank you.
Excellent. Thank you very much. Please, if anyone has any questions for the author, please do post them into the chat area for the meeting. Meanwhile, I'll turn it back to Professor Sagili to respond.
Yes, sure. Can we just put the presentation of Mr. Sugandi so that I can?
Would you like to share the put the discussant
just
slides?
previous,
is that correct?
Yes, so that I can issue all the questions. The previous one, please. The first slide. Thank you very much. All right, now he is right. I mean, he's asking about the number of people. Usually in the researches, we have quite a number of data to work for, but in this type of expert decision models, we have mostly maximum 10 people, 10 experts, because they are experts. They're not maybe ordinary people. And really, for one person, while doing the analysis, many Excel sheets are generated. So it's a real complicated method. So our colleague, Professor Öztürkoğlu, she just required maximum 10 people, and because it's some expert decision-making model, I think it's mostly used in this technique is used in the industrial engineering mostly. And also the criteria is also has to be set, you know, up to 8 or 10. We cannot work with a lot of criteria, and we cannot work with a lot of experts or judgments. So that was the issue. I mean, it's in the nature of that method, I can say. The expo online, but yes. So in this issue, in fact, this was a PhD thesis, and we have conducted a survey, more than 300 or 400 actual users in a bank branch. My student have conducted Melih Coşkun to the actual users, and there we have determined a lot of factors. Maybe yes, we have determined these 8 factors. We had done several regressions there with more than 1 or 2 dependent variables, and also we did factor analysis, exploratory factor analysis, and using with the judgments of these actual users through factor analysis, analyzing their judgments through factor analysis, we have received these 8 final factors. I mean, we reached to this place before with the help of the actual users' decisions. I'm not sure whether I made myself clear. And another issue, do you assign different weights for the experts using no. For each expert, their contribution is equal, but I'll search for that if we can, I mean, differentiate between the experts according to their profession or expertise. Another issue, yes, COVID-19, it was really surprising. The total number of survey, it was around 300. I mean, our previous survey, not this one. Just a question has came and just I answered it for our conference participant. Anyway, I was continuing with the health and epidemic issues. we were surprised. I mean, that factor was identified through the actual users in the initial analysis. But I guess maybe it was a disruption. Now the experts just judged this issue. But this paper is quite a recent one. I mean, it has been done in the recent months. So, I mean, you know, after summer, really the effects of COVID-19 pandemic is almost diminishing. I mean, I don't know what is the global situation, but we don't wear in Turkey masks. I mean, they're not forced anywhere, and the cases are very low. The number of cases are very low. Yes, it changed everything. I mean, it promoted the digitalization in the financial area or in other commercial areas, but it seems that now some other factors are more important, I can say. So I think this is all I'm going to answer. If there are some other issues, I can.
Yeah, it's clear, Professor Saigili. Thank you very much for your answer.
I thank you, Mr. Sugandi.
I guess on the last point, you make a point. I mean, like papers or articles made in 2020 tends to say that the COVID-19 accelerated the use of digital payments, of this kind of stuff. But we need the time to, I mean, more data to be able to set that it is really accelerating the use of online payment. And then I mean, like recent papers when the pandemic itself is diminishing, then we see, like in your paper, that the increasing use of the online payment may be just temporary rather than permanent. People will return to their old habit of using cash, for instance. Yeah, a lot of paper needs to be done in order to answer this issue. Thank you again. It's clear for me.
Thank you.
So if I could ask a follow-up question. So so thanks for answering the first part of the question on the sample size. The second part is about whether it is representative across population age categories. So I think it's an important point because, you know, as we know, there's a digital divide, and perhaps there's, you know, less levels of digital financial literacy for the older age group. So my question is, are your results concentrated on a particular age category, or is it well dispersed across age categories? And would it be possible to have a look at results within different age categories?
Yes, I'll take that into consideration. I mean, we had a big survey beforehand. In that one, usually the studies give a statistical relationship between age and digital usage, but in that survey, I remember we didn't find a relationship between age, but in this one, usually these people, of course, are elderly people. I mean, they're not young people because they are experts in the industry. So I'll take into consideration and discuss the issue with my colleagues. So for the further investigation, for the development of the paper. Thank you, Mr. B.
Okay, thanks. And another question is, so,
sure,
you know, there's a lot been done in this area. So is there something specific in the case of Turkey that can be compared to what is found in the literature in this field, or is the finding for Turkey generally very much in line with the broader findings in this area?
It is in line. In fact, Turkey is #1 in e-commerce, online payment, e-commerce transactions. I mean, in the world, there are global surveys about this. And so that's the reason why we started. I mean, in fact, originally my PhD students started with fintech, but, you know, we don't have a lot of blockchain or, you know, Bitcoin commonly used in Turkey. So we shifted to payments. Why? Because Turkey is very strong in this area, the payment area. And as we all know, payments is the most adopted part of fintech globally also. Yes, they're mostly, I can say, in line. I mean, the world is small, you know, everybody is almost acting similarly.
So I see another question, maybe related to John's connecting this paper to existing literature. Pradeep, I don't know if you wanted to voice it out. You typed it in terms of connecting, especially in the conclusion, the findings to the previous literature. Go ahead, Pradeep.
Okay. Thank you very much for this opportunity and for the nice, excellent presentation also. So my question is that in some of the literature background in theoretical aspect, you have presented some of the existing literatures while picking up the factors that define your thesis as well. So my question is that, like, when I go through those kind of factors, for example, in your conclusion, you concluded that the perceived usefulness is the most significant one according to your finding. But when I go back to your literature, that I found that when you tag some of the literatures on perceived usefulness, so I found those literatures a bit older than the current scenario. So meaning that we are like examining the current scenarios that is coming out from the pandemic, but we are like going to some of the existing variables. So how your present conclusion or present findings are a bit different from the previous one, and how do you connect your those findings on the is there any other recent literature that are available in the internet to conclude your findings, or
Yes.
or to connect your findings, something like that?
I understand your question. The point is, in fact, there are very few studies related to this payment adoption. I mean, most of the studies were done in mobile banking area. And I think there's a research gap here in the payments area. And that was the reason why our theoretical, I mean, just the recent one, we found several literature. So you're right. I think there should be more studies conducted about the issue. Our contribution, technology acceptance model, and there were two issues there: perceived usefulness and relative advantage. So perceived usefulness is the major determinant or factor determined by technology acceptance model. Is a very old theory, I know. And also relative advantage, again, it was determined by Rogers' innovation diffusion theory in 1960s, maybe. These are really very old but very used theories in explaining these kinds of adoptions. So yes, our finding, for example, health and epidemic was a very new factor, but we couldn't find, I mean, it was the least important. I mean, the expert determined it as the least important factor among the others. So yes, the theories are old, but the results are consistent. I don't know how to interpret it, but the results are consistent with those theories, the innovation diffusion theory and the technology acceptance model, I can say. If I don't know whether I am explaining it well.
So my another question that follows your answer over here. So connecting to some of the points of discussions explained earlier. So meaning that after the pandemic, our perceived usefulness attitude may change, as discussions already mentioned over here. So how do you relevant, how do you create some such kind of relevance of your findings to the new era after the pandemic or something like that? That is the most important question.
I mean, during the pandemic was the most important driver for people. I mean, they didn't have any other choice. They didn't want to go to shop and they did everything online. But now, pandemic is not so much affecting their decision, I believe. I believe the system the systems has to be useful. They has to provide advantages for the users. All right, this is what I mean. I mean, yes, during the pandemic, we had to use these online payments, but now people have choices. And also there are many developments, so people will choose from the one which is most useful, and people will choose from the alternative which has the most advantages for themselves. This is what I derive from our conclusions, and I believe the pandemic effects are diminishing at the moment. I mean, I don't know what will happen. Maybe it will start again, the pandemic. So it's hard to really predict the future.
Okay, thank you. I think we're going to have to wrap up this part of our session at this point. Thank you to our author, Professor Sigalit, for our discussant, Eric, and for the questions and responses that we have. We're going to continue to rotate our conference so that it's always morning, as we just heard from our presenter in Turkey this morning there. In our next paper and presentations, it's also morning for them as it gets later for us here in the Asian time zone. So our 8th paper of the conference, our 4th of today, and the final one for this day 2 of this 3-day conference is a paper that will be presented by An Le, who is a researcher at Goethe University in Frankfurt. The title of the paper to be presented is Central Bank Digital Currency and Cryptocurrency in Emerging Markets. So over to you, An Le.
Okay, thank you. Let me share my screen first. So far, so good. Okay, thank you so much for the nice introduction and also for having me here today. So today's presentation is about the effect of central bank digital currency and cryptocurrency in emerging market. The common disclaimer apply as IMFS is paying for my salary. So jump into the introduction. Let me motivate a bit of my research. So there are many great papers at this conference about blockchains and also algorithm in digital economy. And we know that the blockchain technology does open a lot of possibility. And one of that is the decentralized digital currency or common code like crypto or digital money. And then we have seen that the size of the market of crypto assets and cryptocurrency grow so fast recently. Because of that, many concerns can follow, and I list out 3 concerns under the perspective of macroeconomics. Is the high volatility in price, the problem of liquidity, and also credibility of issuers. And then because more and more people is holding crypto in their wallet or digital wallet, then we have some consequences that is lead to the fluctuation in consumption, investment, and outward. And all of this cause macroeconomic fluctuation. And even in the extreme point, and I think it's coming in the near future, is that when the investment bank or commercial bank start holding crypto assets or cryptocurrency inside their portfolio or balances, then we also have problem of financial instability. And then people say that, okay, but we have stable coins. But then the recent event of Terra, USD, and Luna show that stable coin might not that stable at all, and also subject to many concerns that I'm just recently raised. So, but then central bank need to step into this game and react to the changes in the recent development of blockchains and digital currency, digital assets, so on and so forth, because they have the responsibility to control price stability in its own country and also output growth and at some point ensure financial stability. And then that thing about is for the second, if a group of developers can use blockchain and other algorithm to give out, to issue a coin or a digital currency, why not central bank? Why can central bank cannot do it? So if even in the case that central bank use the same technology, then they can reduce the transaction cost because they get around intermediate rate. And then imagine that now every people can have one account at central bank. And last but not least, that's the CBDC is needed to provide central bank a tool to conduct monetary policy for substitution to the crypto. So in here with this, compare some common access in terms of macroeconomic model in few aspects, including scalability, liquidity, risk, remuneration, and international use of the assets. And then somehow CBDC stand out among other assets. Let's quickly compare like CBDC and stablecoin. So both can scale up. I mean, at the end of the day, both have the same technology, can be like that. But in terms of liquidity, stablecoin is questionable because sometimes it's hard to live with. And then in terms of risk, we know that it's not riskless at all. And even in the other side, that's the risk is high, even for stablecoin. And then CBDC provide you a riskless access because it's backed by the central bank. So let's take a quick look at the development of current development of CBDC around the world. So we hardly can see any of major large economy stay out from this game. Everyone want a piece of the cake, and put so much effort in do research and also launching the pilots such as Canada and China. So that's enough for motivation. So what this paper does? So I built up a small open economy with first the banking sector and financial friction, and also foreign deposit or foreign debt in term depend on the language. Second, I allow bank to take a cryptocurrency at the form at deposit, and the return rate is indirectly still from policy rate because deposit return rate is determined by the central bank. And then lastly, that I introduced CBDC as a hybrid tool, so it can be a saving tool and also a mean of payment for and with perfect liquidity. So a preview of key results for the paper. The paper showed that allow crypto in the banking sector actually have significant effect in both macro and financial stability. However, the model with crypto and CBDC seem to reduce the dependence on foreign debt financing, which is important for emerging market economy, which is the main point of this paper. Also, like we find that introduction CBDC do not affect domestic macroeconomic stability. So I mean, with the near future, when we have CBDC, it doesn't cause that much of concerns. And lastly, that under optimal policy exercise, we find that flexible rates also affect the response banking sector and can reinforce the conventional monetary policy for central bank to achieve their target. The literature review is too large to sum up, so there's a few papers here, theoretical model, either on crypto or CBDC, and there's the connection between CBDC and commercial bank, and CBDC and monetary policy and financial stability. My paper lie in the first and the third section. So for the viewer with not so much knowledge in how the macro model working, let's take a look at the model overview. So model, for simplicity, the model have the household, a banking sector, and the firm who to produce goods. And household, they have they put deposits into the bank, and also they hold some crypto and then put it into the bank and return some resistant return rate. The return rate for crypto is the change in the price of the crypto, so it's not affected by the central bank monetary policy, at least not directly. To make it at the emerging market economy, we assume that bank can receive the foreign deposits to finance their activity, and this subject to foreign interest rate risk and also exchange rate fluctuation risk. For lending mechanism, both household and bank can lend to firm, but then we assume that household is not that efficiency in lending compared to bank. So bank is can lend more efficient. And then because it's small open economy, so we conduct import and export as usual. Okay, let's get into the model, and I hope I can walk you through all of this. I will not go too deep into the model structure, so just a few points need to be mentioned. So first is that look at this equation. This is the cash in advance constraint. For simplicity, it's been that you need a liquid tool for payment. So in traditional macro model, you have MT the cash and DC the CBDC. So in traditional macro model, you need cash to pay for your consumption. So CT is consumption, so pay for your consumption good. And now we say that okay, you can, if CBDC appear, then you can use it. And then now the cash in advance constraints include cash and then CBDC. And then we introduce a loss function in terms of household utility. This is to introduce the hoteling linearity. Without step into technical term, the mechanism is that the household, they minimize the available payment tool they have in their hand, and their preference of what tool they are using. So this kind of method can mimic in a simpler way that we have a representative household, but then this representative household make up from many members that have heterogeneous in preference of using cash or CBDC. So think about like young people, they prefer digital currencies for payment, so they prefer CBDC. But then old people, they prefer let's say cash, because of maybe they enjoy the anonymity of cash. And then this lock function may be changed depend on the shop. For crypto, I also follow the other distribution in the field to include it inside also the utility function. And then for the budget constraints household, they finance their consumption by put deposits into bank, also lending directly to firm. And then they can get some return rate for CBDC and crypto. So let's move to the second agent. So it's the banker, so of banking sector. So banking sector will conduct lending to firm, and then they have 4 sources for financing the loan to firm. So firstly, the entity is the network, the own network of the banker, and then they receive some deposit from domestic households, and we assume that they also can receive some deposit from foreigner and convert it into the domestic currency by the exchange rate ST. Actually can, okay. Then they can finance by crypto, and then they have to satisfy incentive constraint for every period, so give by the financial friction. And then good producer use capital intermediate input and household and labor hour to produce good. Finally, central bank will conduct monetary policy based on their to stabilize inflation. And because we are talking about emerging markets, so they also care about fluctuation in exchange rate. So that's too much for the structure. A step for the calibration is quite standard, but we assume the CBDC assume to be the most efficiency even compared to cash. So let's step into result. So we studied the effect of CBDC through impulse response function. So first, based on the current situation of the increase in Federal Reserve rate, I show you the shock, the response to foreign interest rate shock. So in short, the shock co-recession for the emerging market and cause the depreciation in real exchange rate. It's put exports, so the trade balance improve. However, the depreciation lead to higher inflation rate, and then central bank had to raise interest rate just follow Taylor rule. And then because we have the foreign debt in the banking sector, so this amplify the problem and push down investment and bring also consumption. But let me show this your attention here. So we have four version of the model here. So the base model is CBDC plus crypto and plus cash. And blue line is the model with only cash. The red line is cash and CBDC, and the purple is cash plus crypto. And then let me let your attention for every model with crypto. It seems to show you the less severe recession in response to foreign interest rate shock, even in terms of macroeconomic variable or the net worth of the banker, so and credit spread. So even in both sides, in macroeconomic and financial at the same time. So we reached the conclusion that crypto can help because they provide additional resources for the bank to conduct their lending. So they partly help the bank to let depend on the foreign interest rate hike. And then I compare other alternative of CBDC design. So we have three more models. One is a flex model when the rise of CBDC is determined kind of Taylor rule. So to control inflation and output gap, the markdown model will deduct some percentage point from policy rate and give it to holder of CBDC. And the quantity model, it should we fit the supply at a proportion to the output, and then let the market determine the price, and then the price is just the change in price of CBDC. And then here we have the 4 different versions, and we saw that with different version, different design of CBDC, we also have different response in macroeconomic. And then the most different is between the flex model and the other. And the difference is not only the substitution between CBDC and cash and more, but then also relate to output and consumption. And also the same thing, but not significant, but the same thing happened with foreign interest rate shock. So we're thinking about this. So let's say how about optimal policy with the presence of CBDC. So we do it by optimize the response for of Taylor rule to inflation and exchange rate through different versions of the model. So and on we did it on purpose, is that we do not impose upper bounds on the reaction to inflation, which usually is a common practice in profession because it affects the welfare a lot. But then let's look at here, because only in the flex model they have a non-zero. They allow for non-zero reaction to exchange rate for central bank. So this to keep this bring us to the one of the final conclusion is that actually the flexible rate in CBDC can help the central bank to mitigate or stabilize the price stability, and then give space for them to actually have some control in exchange rate fluctuation. This is which is really important, especially during this time when we have the unprecedented speed of interest rate hike in the US. So for conclusion, and I hope I'll be on time, the introduction of CBDC did not affect the domestic macroeconomic variable that much, especially when we take away the saving ability of CBDC. But then allow banker to hold crypto can at the same time mitigate the negative effect of the same shock. But we also see that there is significant difference in response when we allow for cryptocurrency. This opened the question of whether the regulation of crypto is necessary or not. And then cryptocurrency CBDC seem to have to reduce the dependence in foreign debt in banking sector. And finally, through optimal policy, and we see that CBDC, if we can design it optimally, it actually can provide the power tool for central bank to achieve their target easier. So thank you so much, and I'm welcome any question, and I hope I can clarify it.
Excellent. Well, thank you for that presentation. We're going to hold on you responding to anything until we get our discussant in. I noticed that there has been a question raised already in the chat, and I'd encourage other people, participants, to also raise questions in the chat. But first, while we turn the microphone over to our discussant, who is Ghaziuddin, Associate Professor of Economics at Linköping University in Sweden. Over to you, please.
Yeah. Did you see my slide?
Yes, we can see them. Okay.
Just check it, right? Okay, then. So thank you very much for a nice presentation by Lee. So I have just a short, yeah. So in your study, you introduced the new Keynesian dynamic statistic general equilibrium model to explain the implications of CBDC and the cryptocurrency in an open economy with financial friction for emerging market. The main key findings based on my understanding of this study is cryptocurrency has a crucial role in banking sector and had a significant effect on the dynamics of foreign debt, which is deeply important for emerging market. And you also highlighted under the different monetary policy scenario, a flexible rate in CBDC can affect the response of monetary policy rate and can reinforce the conventional monetary policy to achieve the central bank's target. And the main conclusion idea of the paper is quite innovative, as it includes the CBDC and cryptocurrency in an open economy setting with the endogenous bank's balance sheet. The model also analyzed the effect of different shock in a small open economy context. So I will not to go for much details about your equation. So I will mostly go for the comment of the your model and the clarification. So my comment is based on your analysis of a foreign interest shock, the presence of cryptocurrency in the banking sector reduces the effect of foreign shock. But however, my concern is that, however, since the beginning of 2022, the foreign interest rate like Fed fund rate has increased significantly and the value of cryptocurrency has plummeted, and the result based on your model, if I understand, is not consistent with the based on the current fact of the movement of crypto asset during the persistence of foreign interest shock period. So I am just looking for your opinion in this context. My second concern is from the macroprudential and regulatory point of view, allowing the bank to hold the crypto assets as a part of their balance sheet may create the financial instability, as the crypto asset is very volatile and which is already been clearly observed in the previous literatures and look at the data information. So how did you think about these issues? And I didn't find much discussion in this particular point of the volatility of the crypto asset. Then I also need to know more about from you, what is the motivation of choosing GK framework to a model in the banking sector instead of another framework such as Garley 2010, because GK framework is based on a perfectly competitive banking sector, where Garley focused on more monopolistic competition. So we need to you need to highlight it some of the stress why you are choosing one framework to the another framework. Then second, this is the most important part of the my questions are the value of the parameter in your paper based on the emerging economy data or not. So I think this is, you put it in the future study, even though you put it in the field, because the study is based on the emerging market. So I strongly recommend that the parameter should be based on the emerging market, or you need to be more relevant emerging market construct, or to calibrate choose the value of the certain parameter to match the emerging economy. So I think in this part the result is not clear about, because I think you wrote something about that you will do some future study, but I'm more interested to know about the current parameter based on the emerging market context, as that is the main contribution of the paper. Then also you highlighted that the model is used to analyze the effect of different shock in a small open economic context based during analysis of a foreign interest rate shock. The presence of cryptocurrency in the banking sector reduces the effect of foreign rate shock. But it could be further developed to provide the rationale why the presence of cryptocurrency in the banking sector reduces the impact of foreign rate shock, and should be divided looking into the macroprudential policy in conjunction with the monetary policy. So that's could be one direction that you need to think about it. Furthermore, although the study implication on the banking stability and welfare, but the analysis disregards the potential negative impact of economic growth due to the banking shifting their portfolio from the more profitable but riskier investments towards the less productive but safer one, thus failing to address the key trade-off between banking sector stability and output growth. So these are the part of the discussion I didn't look about in your paper, because building on this area, if you look at the Benark and Garter 1989, Miskin 2000, one possible extension could be incorporated this trade-off in the current analysis, divide the optimum level of capital that prevent the crisis, which also preserving the economic growth. Then also you perform some welfare analysis, but they do not provide any information about the optimality of the rules, neither macroprudential nor monetary. The analysis should be complemented with some optimality conclusion, and furthermore, welfare in this kind of model is not a micro-founded, so results should be also complemented with some of the analysis based on the loss function. That's my understanding. And need to improve more economic and financial interpretation of the result and argument based on also the previous theoretical models. So that's all about my comment. So if you have any details, clarifications, or some explanation, happy to listen from you. Thank you.
Yeah.
Great. Before you jump in, maybe I had a couple of questions, but maybe John in particular, I think if you could raise your question. Eric, yours seems a bit more on the technical side, so maybe we'll reserve that to see if there's time at the end. John?
Yes, thanks very much, and thanks for the presentation. So my question is how you treated CBDCs and cryptocurrencies in your model, whether they are substitutes or complements, because I think that would have an impact on your findings in relation to the relationship to foreign debt. I think, you know, the general consensus is that as retail CBDC would develop, it would replace this payment role that crypto has at the moment, and then that would leave cryptocurrencies much more for speculative purposes and reduce their you know, role in payment systems, and therefore really limit the role of crypto in terms of you know, the implications for the wider macroeconomy, as well as for what you're finding with the foreign debt issue. So yeah, so that's the question: how you're treating the relationship between CBDCs and cryptocurrency.
Should I address this question?
Yeah, why
first?
don't you go ahead, and Eric, we'll hold you back for a second, but
So in the
you'll
model,
respond to the discussants and to John's questions, please.
Okay. So in the model, we assume is that cryptocurrency cannot be used as a payment instrument. So only cash and CBDC can be used like that. So crypto normally is to use for investment to get some return in that. And we see it actually in the reality, because it's only small fraction of shop or small economy that allow like Bitcoin or something cryptocurrency to use for payment. So actually the CBDC is introduced to like one stone hits two birds. So one is that to substitute or complement to cash payment, and the second is that provide let's say maybe lower return rate, but then riskless saving tool to substitute cryptocurrency.
Yeah, like as we would move to CBDC, there's obviously less risk, as you're pointing out, and even what we see at the moment is developments with stable coins, which are actually not so stable because they're backed by assets which are volatile in themselves. So I think that, yeah, I think it was a great paper, and obviously we're lacking data to really look at this in detail. So we're limited to theoretical studies. So I was very interested in the findings that you had. So thanks a lot.
Yeah, thank you for your question.
Do you want to try to, I know that there were at least 3 major points raised by the discussant. Anything that you want to respond to?
Gazi, can you share the slide again? I mean, I'm terrible at remember
can we try to put his slides back up, please?
Yeah, just jump to the comment mail one. I mean, I go one to one. Yeah, so first is that the model is failed to, and then to the best of my knowledge, I'm not aware of the DHV model can model the volatility of crypto. But then also in the industry bond, we saw that with the rise in interest rate, actually, if I'm not mistaken, is that the crypto holding in the model also decreased. So at some point, it's not too far away from realistic. But then I admitted that it failed to capture the volatility, and I also accused that even without volatility, we saw the huge difference when we including crypto inside the banking sector, which is something that is not common right now, but very in the near future. And then that's call for regulation. Yeah, so because of the model cannot model the volatility, so we haven't touched the dangerous part. And I think you make a fair point, but it's really hard to get it there. But then I understand that. So can you move to the next slide? I mean, if you don't want to. Yeah. So among model with banking sector, I mean, I also aware of model of Shirley. It's just first is that it's good because the model of Shirley is that in model of interbank market. So we have several banks there. And then what we want to see here is what I want to model here is just use the GK framework to model financial friction, and it's just easier to incorporate foreign debt there, and then to introduce the optimal portfolio choice between domestic funding for bank and foreign funding for banks. So it's just easier to introduce. I mean, I'm encourage people. I mean, it should be a great paper if you modify the framework of Shirley also. So, and then also the parameter actually it calibrate mostly based on model of Aoki and Kiyotaki, which build eventually for emerging markets. So we build up mainly from that. So actually, the parameterization is actually take into account the emerging market. We thought about estimated, but then we don't have any data in CBDC, at least reliable data. So I mean, in the near future maybe, but yeah, until now we depend on our calibration. Yeah, so the same at the first response is that we talked about macroprudential, but then we need to talk about architecture of macroprudential. What's this by, or what is the reaction of macroprudential tax on macroeconomic or financial stability? But and then we also doesn't catch the volatility of the price to the whole picture. We just but then the only thing about crypto in the model is that the return rate of crypto is not affected directly by the central bank monetary policy, and that's what we see in the reality, but we fail to catch the volatility.
I think we may only have time for just one quick last comment.
Yep.
I don't know if you want to flash 4 on there or not.
So yeah, I mean, I think I have one more question. So for the DRI model is I don't, and I let the method of the computer to do it. Firstly, because we need to do the welfare analysis at the end. And the welfare analysis only can be done in second order approximation. So if you derive the model first, then the welfare is not sufficient to optimal with the welfare optimal policy. So that's the short answer to the question of
thank you. Excellent. Thank you very much for the presentation. Thank you for the discussion. Thank you for the questions. So we're going to move to our final segment of today's session, which is a keynote presentation. So the title of our keynote for this day 2 is Sustainable Digital Finance, Status Quo and Future Research Avenues. This keynote will be given by Professor Thomas Puschmann from the Department of Banking and the director of the Swiss FinTech Innovation Lab at the University of Zurich. So please, Professor Puschmann, for the keynote, the floor is yours.
Could I ask just first, Dave, can we do a photo of all of the participants here now, just in case we lose some people at the end?
Very good. Okay, so before we allow Professor Puschmann on, if I can ask everyone, if you're online and able to turn your cameras on, and we will do one photo since we've had a number of folks join us, especially in the European time zone. So let's see, is it Tokyo or Singapore who's going to be taking the photo?
Okay, Atsuko-san, are you there?
Okay, yes.
Okay, so tell us when you're going to take it.
Yes, okay. So
again, if you're able, I think we got a few more people maybe who can turn their cameras on.
Okay, I think you can go ahead.
Okay, 3, 2, 1, smile. One more. 3, 2, 1, smile. Cheers. Yes.
Thank you very much.
Perfect.
Okay, Dave, go ahead.
All right, very good. Professor Puschmann, we hope to welcome you to Singapore or to Tokyo soon, but in this virtual space, the floor is now yours.
Okay, thank you very much for the introduction. I hope you can hear me, see me, and also can see the presentation. Very good. That's a very good start. Good morning, good afternoon, good evening to whom it may concern. Great pleasure to be here. Maybe first I must say that I will be the sole presenter here, as so young will be in the background. So we decided that I will give the presentation. Yeah, we will talk, or I will talk a little bit about sustainable digital finance, a topic that we have taken care of in the past few years, about status quo and future research avenues. And I want to start with a framework that we have also used to structure the field a little bit more. Because as we can see at the moment is that the financial system and the financial sector as a whole is currently being transformed by this twin transformation, digitalization and sustainability at the same time. And these are the two axes that you can see here. So in terms of sustainability, economic, social, and environmental sustainability, and in terms of digitalization, several technologies that are currently shaping this sector, like quantum computing, DLTs, AI, and so on, and many more. So we could see that these all has an impact on the financial sector, being it in payments, in investments, financing, on the whole domain, and also on the insurance sector as well, that is taking care of prevention and protection. So we saw that existing research on the topic on a more comprehensive level, which bridges all these areas, is still rare, and a more comprehensive understanding of the domain is a missing component in existing research. However, we identified, and I will come to this a little bit later, that some research already focused on single case studies, for example, or single fields of that. And our research then examines the emerging field, which analyzes these driving forces. So how did we do that? How did we approach that? First of all, we saw that we need to analyze what is around there. That is covering really a systematic literature review over the past years. We also looked into not only academic literature, but also non-academic one, where we didn't find really more structuring guidance. This was more of a help to also see maybe what the media is paying attention to. We then, in a second step, identified those research papers that are used then in a second step for more comprehensive startup analysis. Because as is often the case, the incumbents are not that innovative as the startup sector is. So we decided to focus on this sector when it comes to looking forward. We found a set of 126 startups at that time. We now could extend this database to more than 300. So this is a growing field. I will also come to that a little bit later on. In a third step then, we used both the academic papers and also the startup analysis to outline these findings in a research agenda of the future research avenues. So that was basically the procedure that we followed. And you can see what we found here in our literature analysis. We could find academic papers, and we then clustered them. We tried to structure them according to a taxonomy. That is a method or an instrument that is very commonly used when you try to structure an emerging field that is novel and not so much literature is around. Then you can approach it either from an empirical perspective and say, okay, what are we seeing in the real world, in the startup and in the incumbent world, in the industry? Or you can say, we start with academic work that is already around. As mentioned, we approached this from both perspectives. So we started with that one. And we could found 4 major topic groups. Maybe this is something that is not shown on the slide here. So one cluster of the papers focused very much on sustainability and digital supply chain management or supply chain finance. A second group was more focused on energy-related topics. So like, for example, peer-to-peer payment, blockchain models that are used in energy trading. A third group more on social sustainability topics. And a fourth one was focusing or is focusing on circular economy and smart cities. So like, for example, you get rewards for waste management in forms of tokens and so on. So then we tried to cluster it according to the results we found here, and we did that in terms of perspectives, dimension, and characteristics. So each of the perspectives then breaks down into different dimensions. Here on a strategy domain, for example, this is business models and product and service types, which then breaks down again into characteristics, which, for example, on the business model side is customer intimacy, product leadership, and operational efficiency. So a business model, that is what it means, can basically be built on three different paths. This can either be a client relationship, which is then called customer intimacy, or it can be product leadership, which is based on products excellence, or it can be more focused on the back office side in the banking sector, which is then focused on operational excellence or operational efficiency. And you can do that also for all the other things. So we did that for the organizational domain, like network type, stakeholder interaction, business processes that are very common in that field. And also for the technology, we call that systems perspective, which we broke down into application types and application design. So being it fintech or insurtech applications or blockchain applications, we took that as a separate field because we saw that blockchains are very much of a trend at the moment, as we also saw that in the previous presentation about CBDCs, for example. And a fourth perspective was on sustainable benefits, which then breaks down into the economic, social, and environmental sustainabilities, which we can structure along the sustainable development goals. And the last row that you can see mentions this can be an N, which is then a non-exclusive characteristic, or it can also be an exclusive, which would then be an E. This means you have to decide whether it can only be SDG 2 or 1, for example. So we used this then in a second step to analyze the startup sector. So we applied this model for the 126 startups and clustered them according to that structure, aligning it to the four perspective and to all the dimensions and all the characteristics. And you can see the percentages here in brackets. So for example, 7% of the startups that we identified from the 126 focused on customer intimacy as a business model. 4% focused on product leadership, while 89% focused on operational efficiency. So what does this say? This basically says that most of the startups at the moment that are around in this sustainable digital finance field are very much focused on incremental innovation. So they are focusing more on optimizing the status quo, for example, by providing better data for incumbent firms. That is also reflected here in the product service type, as most of them focus on business services, 82% of them. So that was a clear trend. And we don't see yet so much more focus on new products and services or on new customer-related fields, which are more focused then on disruptive innovations. So this is a clear trend that we can see. If you go down a little bit more to the business processes here, we can see that, well, it splits up quite equally among the different financial processes. Having a focus on financing with 37% of them, trading 33%. That is not very surprising if you think of carbon trading models, for example. And on the investment side, these are all examples from the impact investment, where you have, for example, robo-advisors that are focusing on the more green investment side. We could also see that there is a clear trend here on economic sustainability. SDG 9 here is in the focus, and followed by environmental sustainability. This is also not very surprising, as climate change is one of the core topics. Very often the startups are also coined as climate fintechs. So this is also a clear trend that we could see, followed by SDG number 7, which is on 65%. All others are lower a little bit. As you can see, some are not in the focus at all. So this is how it splits up at the moment. And if we go further now, what conclusions can we derive from that? So first of all, I want to go into the more strategic view. As mentioned, there is a trend at the moment very much on the blockchain, on the decentralized economy, which we could also observe in our startup analysis. So we could see that this peer-to-peer economy is something that is currently shaping, and we saw that this might be a bigger trend that is around. Think of DeFi and other models, or the CBDCs that we are currently also seeing. They could also be a tool for providing more payment solutions, for example, for this peer-to-peer economy. However, there is a clear trend here, and we see that there is the sustainable digital finance service providers might be kind of a tool or of a glue between the different kind of ecosystems. So if you break down this consumer economy into the different fields of life, like mobility, health, work, entertainment, and communication, shopping, living, and leisure, you can see that many of those decentralized systems are currently evolving across all of them. And we put some examples here, like shopping, OpenSea, or media chain in the leisure area. And we can also see that these sustainable digital finance providers try to embed themselves into these decentralized economies, like digital ecosystems is also a term that was coined in that respect. So many of them provide services that can be used here. For example, one is listed here, the economy, which provides a tool that allows you to calculate your individual carbon footprint based on your payment transactions. MasterCard, for example, uses that, so you can calculate your greenhouse gas emissions based on your payment behavior. So that is something that we could observe here. We try to translate that, our findings now, that we that are based on the literature analysis on the one hand side, which is one column here, and the summary of the startup analysis. This is very small. You don't need to read that, because the summary of the research avenues is put on the far right here on the 4th column. So I will describe this a little bit. So on the business model side, we think, based on the findings that we have now from our analysis, that we can see at the moment is that questions that arise here: what will future business models, especially the disruptive ones, look like if sustainability concepts are applied? Like carbon markets or new pricing mechanisms, new models there. So how will they look like, and what patterns will they follow? How can innovation be fostered between incumbents and startups? Because we could also observe that most of the models are currently focused on the business-to-business side. And also a question here is, how can deregulation be used to foster innovation? Because what we also can see is that many of the startups are still struggling also if they are entering a regulated environment that is not only driven by the financial services industry, but also by other industries. If you think of embedded services into other ecosystems, the retail sector, for example, or other fields, they also have regulations in place. that also cross that sector now. So you not only have to follow then the financial services regulation, but also others as well. On the products and services side, we could see that, or there are also questions that are that come up here. For example, how can the environmental awareness of individuals be further promoted to influence customer behavior? We think that the whole consumer behavior side is a very big driver of change. Because we are the ones that consume and we are the ones that also influence the products and service providers out there. And if the financial services industry and the startups specifically will provide tools like the economies carbon footprint analysis tool, for example, would give us further transparency and would maybe also try or give us more guidance how we could change our behavior for the better here. Another topic here is how can different product categories be enriched with sustainable digital finance? How can they be evaluated regarding the social environment and economic input? For example, product and service taxonomies. What we currently can see is that it's still very hard, for example, to analyze the scope 3 greenhouse gas emissions in supply chains. Rather, is it not possible to really see how that breaks down into a certain product, for example. So this is also one of the core topics here. So let's follow. So these are more of the strategic questions here. If we go to the more organizational questions, then we could see a clear shift from this provider-centric perspective to the client one. We talked about this changing consumer behavior already. So now we have the situation that it's not only the incumbent banks that are around and provide services, but we also have the startups that are the new entrants. We also have the manufacturers and the supply chain providers in which all these new services are embedded as well. So this is a very new field then, and there is a shift going on. It's really a paradigm shift that is very much driven also by digitalization as well. So what does this mean then from the organizational view? So if we look into the networks and the network types that we saw, we have questions along what is the impact of other industries than the ones in focus at the moment. I mentioned that we have, like, for example, we have energy in the focus. We have financial services, of course, in the focus, but there are many others around. So how can they be embedded, all these climate fintechs, for example, into other service industries then? And how can these finance-enabled sustainability concept be organizationally integrated into these cross-industry ecosystems? I think this is one of the core questions here if we talk about the networks. If we go further to the stakeholder interactions, then other questions come around, like what are the typologies of future sustainable digital finance ecosystems? How can transparency among the different stakeholders in these ecosystems be enabled, and what impact does this have? How can the governments also be integrated? We could see from our analysis that they are not part of that ecosystems at the moment. Think of RegTech solutions, for example. One strong trend in this sustainable digital finance fields is also to provide, for example, green RegTech tools, blockchain auditors, or something like that. This is not something we can see at the moment. So this whole policy environment is something that will emerge. In the business process field, how can they be optimized by using those technologies, like increasing transparency, and how can also ethical implications also be reflected then? Think of social dimensions and so on. Then last but not least, the technology field is also a very important one. And here we can see that technologies developed over the past years in a tremendous way. And I put here two acronyms, the QUART and the MAX. QUART stands for quantum computing, for the Q, A for artificial intelligence. R for extended reality, and D for DELT, while MAX stands for mobile, analytics, cloud, and social. While MAX is something that we can already see. Those trends have already emerged, and they, by convergence of these technologies, they already provide or are used by many service providers. On the other hand, the Quart is something that we can only see emerging. Like quantum computing is very early, AI is very early, extended reality like the metaverse is also very early. So there are many new technologies around that also converge with these existing ones. So I think there is a big range of novel themes that we will see in the next few years, really speeding up this whole development. So what does this mean also for the research dimensions here? Application type and design. So this means that how can, for example, already existing and new data sources be used, such as open data initiatives from governments? How can they be used to be enriched also with the existing ones, and how can they be used to be embedded in these new ecosystems and will be used by the startups? Then specifically for the blockchain domain, as this was something very important here, how can this be leveraged for this finance domain? And how can the new systems such as cognitive and neuromorphic computing, for example, be connected? And then what are requirements in terms of standardization, data security? What are requirements for different systems to be integrated across the different functions? So there are a lot of questions, like also new technologies that are around edge computing, digital twins of consumers, for example, that can be built. So there is a whole range, a whole bunch of new things coming up there. Last but not least, the benefit side, which we distinguished here in business benefits and sustainability benefits. I think there is a big trend to align both of them. So sustainability benefits alone will not be the one thing, and the business benefits, we could see that will also not be standing alone anymore. So there needs to be like an integrated model, how we can really combine them and be aligned in an integrated framework. How can new tools and instruments be used and be scaled beyond their today's usage, CBDCs and stablecoins and other things for financial inclusion, for example. And we could also see that the SDGs are not all of them are part of the research at the moment, and also not part of all of the startups at the moment. So there is also should be a broader focus on more of them. Besides only focusing on the few ones. So this is also something which will be needs to be done in the future. So let me summarize here. We could see some first patterns in this emerging sector, both from an academic perspective and also from the practitioners' view, from the startup field. However, it is still very early and still an area for future research. And of course, real data is not all around. So only the startups do that. There is a few academic papers around, so it's very limited at the moment. Therefore, we need to look also more into the data and what it really means. I think the perspective third is on startups that are starting in these digital ecosystems, which we could observe very much in the B2B sector. I think what is also important is the role of regulation, because especially if you look into the financial services sector, this is a very important driver also of innovation. You can observe that all across the world currently. When it comes to crypto or other regulations, this is a big topic on G20 level. So there needs to be a clear view on that and a clear framework for that, which is not only focused on isolated countries, but I think it needs to be kind of a global framework, and it will be interesting to see will we be able to achieve that. And fifth and last, of course, this is a snapshot, and more longitudinal studies will be needed in order to really evaluate this and see whether there are other topics that come around. So thank you very much. Let me put some last words. We are currently in the process of shaping a new joint effort of Stanford and the University of Zurich, which will be termed the Global Center for Sustainable Digital Finance, where we will focus on this topic. And I'm looking forward to collaborating with some of you in the near future. Yeah, and I'm happy to take any questions or any other comments from you. Thank you very much.
Thank you very much. Thank you, Professor Bushman. And we just have I think we'll be very encouraged, we will all be very encouraged by this keynote in terms of not just the evaluation of where things stand, but much more importantly, the many directions that this research can take going forward. I know that you've got your collaborator, Dr. In So-young, also on the line. But John, can I just check with you what, from time perspective, what should we do at this point?
Yeah, well, we can have some questions from the audience.
Okay. So if you'd like to either open your microphone or to type into the chat, please do so now.
I have one question myself.
Sure, John, why don't you go ahead?
Yeah, so thanks very much, Thomas. That was a very interesting presentation, very relevant topic, of course, and I'm looking forward to seeing how your research with So-young develops as we move forward. But I would like to ask you what you see as the main obstacles for green fintech solutions going forward. I think, you know, this shift towards climate fintech is obviously most urgent for economies that face the largest risks to climate change. So what are the real obstacles in progressing with this from a regulatory perspective, from, for example, understanding how to price risks and returns, which are obviously crucial. I think there's a lack of understanding of risk-adjusted returns in this space. And another important issue is compatibility of regulation across borders. So that's going to be a crucial factor. And I think there's obviously concerns there because it leaves exposure to arbitrage and things like this, which can actually inhibit the growth of the types of green fintech solutions and sustainable digital finance solutions that you're talking about. So what's your opinion on the main obstacles faced to take this further?
Yeah, thanks for your question. That's a very good one. Yeah, so one of the obstacles that we can see is, and you mentioned one, is really the cross-border regulation. I think this is a very important point. There was, for example, Switzerland took action in last year with a green fintech action plan. We outlined 16 activities that need to be done really to bring this topic forward. And one of them that was very important was the access and the availability of data. So I think this is really one of the core elements here. If the green fintechs will have access to this data, they can also provide these sort of solutions. Not only data that are relevant for sustainability, but also when it comes to open banking and open finance. Combining these two. In Switzerland, for example, we don't have an open banking scheme yet. So the banks still say we're doing that by ourselves, by providing these interfaces. However, this hasn't happened over the past years. So this comes very much in line with what you said about cross-border regulation. I think these are the two main points here.
Okay, thank you.
Yeah.
I guess maybe I'll just jump in, and maybe this might have be the last comment that you can maybe respond to, which is, that for this audience here, since we're co-hosting this out of Tokyo and Singapore, first off, I would say that it's sort of shocking as you did your evaluation in that absence of what we were just discussing with John, regulation as being a key point of an important potential obstacle in the way you respond to the question, but also that the absence of research in that. So that does seem to be the most obvious yawning gap. But in a number of the ones where you detailed, where the agenda may go in the future, things that caught my eye for those of us out here in the region, in terms of the products and services and how maybe across cultures, there may be some differences when you talk about business processes, things like ethical implications where values may and the perspective of those may differ also in Asia versus, for example, the rest of the world. Any thoughts on that in terms of how the research agenda moves forward and how it might, for those of us based here in the region who tend to focus more on Asia, how that agenda might speak to us and what the priorities, at least in your opinion, would be for researchers based in Asia?
Well, I agree. The topics and the focus area would probably differ if you look in the more developed countries or the more developing countries. That's for sure. For example, also if you look into Africa, for example, it would also look a little bit different. That's why we put the cultural differences also as a part of that. However, I think the potentials are big or great at all sides. So, but yeah, well, it's a little bit hard to give an answer to that because a spectrum is so broad here. You probably would look really into that from a country-specific perspective. Also from a regional one, there is one example that stands out very often is the developments in Asia and Africa, where you can see like payment technologies that are emerging across not only countries, but across regions, because they want to improve financial inclusions and make cross-border payments better. So I think this is a very nice example of where you can see that fintech can really have an impact, where people can use that as a tool to work across borders and bridge those cultural differences. However, this is a topic that really needs to be focused on more in the future.
Dr. In, I see you turn your camera on. I didn't know if you wanted to say anything.
Yeah, hello. It's glad to join us, join the workshop, and thanks for inviting us. And yeah, here in the United States, it's a pretty late night, so I was kind of turning off. Yeah, but to add on, Thomas, great presentation. I just enjoyed myself, listening to our paper. But to both of the moderators' comments, I think what we are seeing is, like the balance between the system transition versus the innovation. And then both are important. And I see the system transition is more about the policy implementations and so on, should be kind of supporting, should act like a supporting roles. And then for the innovation is more about the market led. So why I am having this kind of like a two division is, when we are talking about something very new, like people think that, oh, okay, like this is very like a forward-looking idea, but like we don't have the system, is not there. So like we have to prioritize something. But I think that this is system transition and the innovation should come at the same time. Otherwise, I think we'll be soon facing the problems that we are having. The getting the carbon accounting and carbon pricing going off from our control and then hand. So like what I'm saying is that this digital innovation and then the convergence of this new technology into the field of sustainable finance is happening. And then, it is actually happening across the border. However, especially the developing countries, they tend to prioritize, getting the regulations, sorting out the accounting problems first and so on. I mean, both this is very important, but I think, we have to really also, have an eye on, what is actually happening in the market and how this policy implementation can go in the aligned way, those, market transition. So this is something, having like a different weight, although the choice of the weighting is different by country or culture or the reasons and so on. But I think, this is kind of like a consistent framework that we can look at. And then in the end of the day, what we are seeing is, developing those two tasks in hand in the balanced way. So that's kind of like a long answer to what I'm thinking about, how can we, approach this, digital innovation in sustainable finance from the policy perspective or different perspective from especially the developing countries in Asia.
Thank you very much. I think, John, I think you agreed. I think this is a very good time to close this day in this session.
Yes, I think so. Thank you very much, So Young and Thomas again for the presentation, and So Young for your comments afterwards. I fully agree with you, and yeah, I think your work is certainly something that we will pay close attention to going forward. So thanks a lot for that.
Thank you.
Thank you, everyone. And so with this, we're going to close day 2 of the conference. We thank all the presenters, all of the discussants, and our joint keynote presentation, all very stimulating, a lot to take in, but we will be back tomorrow for day 3, the last day of the conference. And so we look forward to all of you joining 9 a.m. Singapore time, 10 a.m. Tokyo time. Thank you very much. Have a good evening.